So I'd love to welcome our next speaker, and our next speaker is Alan Borthwick. He is a guy I've known for about 5 or 6 years, isn't it, Alan, that I've
Yes.
known you. And he's one of the youngest financial advisors in New Zealand, an amazing mortgage broker, and just a guy who is really passionate about making sure that people understand money in order to be able to have a better future. So Alan, I'd love you to tell me a little bit about why you got into the work that you're doing. What's led you to this now?
Yeah, so the path of getting into the financial service industry was just accidental, but once I got into it and learned about the process and went through my own journey with money and realized some of the mistakes I'd made over the years, I can summarize my education at school on money as don't get to hire purchase, which is, was correct, but there was no context to it that did anything for me. So I've been developing more ideas around this as I've gone. And then in 2011, when I started doing some financial counseling work and got confronted with the reality rather than the academia maybe, and the high-end stuff we're taught when we're trying to sell stuff to people who have money, it was having to deal with people who didn't. And how do I get people from negative back to zero and then upwards? And that sort of framed what I see as, I guess, good habits that, if it works for someone who's trying to claw back $80,000 of debt when they're earning 60, that it works for anybody. It's concepts that work so that they help people grow and do better than they are now. So that's been my journey, is developing and testing, and basically I'm live testing a lot of these concepts every week with new people, and getting good feedback, and as banks change rules and what stuff like that. So it's seeing the difference in people's lives because of the decisions you've made with them and help them do, and they're able to see some clarity because they're not getting it from the media or government or banks. So it's able to get them to cut through the nonsense, see things with clarity from a New Zealand perspective as well. In a lot of cases, there's some good stuff out there, but it's very American, which is fine, but you don't need to sit through something telling you how American investments work.
Yeah, absolutely.
So,
Alan, what do you see are the current challenges in the education system?
I think the challenges are, you've got a situation where people are being taught very theoretical in academia, and no attack on teachers, but if you haven't lived and breathed the reality of stuff, how can you teach it? I mean, you can teach theory, but, and I can see this even at a university level, sitting in a room full of academics telling us how people should be with money, and they've never been near a client, never been across a table from a family who's going through hard times. So the challenge is how do you get the reality of life down to people when stuff changes? Through my degree, I was told, it was fun in computer science, so different, but I was told on day one it was already outdated. I was like, oh, which was great. So the concepts were relevant, but the specifics were not. Well, that's true of everything. If you're trying to teach how money works and you're basing it on 3 or 4 years ago in New Zealand, things have changed. So I think that's a major challenge, is that it's purely seen in some ways as a way to get a job, way to get you the next level to university. It's theoretical, and the vocational, there's no woodworking equivalent for financials. I think we might have done some budgeting in first form, whatever that is considered now. I don't know what year that is now, back in the day, but it was very low because this was before computers when I did it. And nowadays I've no idea, but again, it's not practical. There's some good stuff out there, but it's educating teachers about the reality, and if their finances aren't in order, how, and a lot of them aren't, how are they going to teach their students? I don't think you can be an imposter on this stuff. I am not going to be teaching singing to anybody. I cannot sing to save my life.
And that's one of the things, isn't it? Is that it is a journey, and it's about going from where we're at with our money, and then
Yes.
And dealing with our background, if you like, being able to build on that. And it is about taking that theory away from it. And I think one of the challenges is that money is not something that we've talked about for many, many years. People have hidden their incomes. People don't talk about their expenses. Yes. People don't talk about how they're making ends meet. It's something that's kept in private.
It's a taboo subject. Everyone wants to keep up with the Joneses, but no one knows that the Joneses are broke as well. And that becomes as a revelation to people, and they realize, actually, I'm not special and unique in this. I'm probably like everybody else. But we hide it because no one wants to talk about it unless we're asking for help. And by that, or we're going to hand out. By that point, it might be too late.
Absolutely. So, Alan, thinking about what do you wish you'd learnt at school?
I wish I'd learned about, I guess, one, compounding interest in real specific terms, as well as the different effects of that. So from a debt perspective as well, because for all the power of compounding interest for savings, it has the exact same reverse effect when it comes to debt. I think one of the things I've realized is that when you're 16, 17, 18, you've got what looks like forever in front of you. And by 25, you suddenly realize, oh, maybe it's not forever, but it's a long time. And, I describe it to clients as when you're 18, retirement, and let's say with the current expectation that's 65, retirement is another universe, it's another reality. And as you go, then it goes to another planet, and then it's another city. And now it's another street. And then one day it's next door. And so and it's both very slow and very fast. And that's something that I don't think, even now, it's taking a while realizing now as I'm in my early 40s is going, oh, I'm at a potential midpoint, and everything I did leading up, beforehand has led up to now. And if I'm still in negative, I haven't even started yet. So the earlier I can start, so it's not even necessarily the maths of it, it's the practical reality of what life is. And I'm not sure how easy that would have been to teach a 17-year-old who doesn't want to be there. But in my experience of sitting in classrooms with 17-year-olds, which isn't massive, but I've done a little bit of it, showing them core concepts around, the multiplication of compounding interest, the rule of 72, which in the short version is if you take the number 72 and divide the interest rate on an investment into that, that's how many years it will take to double in value. So if I invest $10,000 at 6% after tax and stuff like that, then it will be worth $20,000 in 12 years. The same is true of inflation when it comes to reducing spending power and things like debt. So that's, if I had known that would be something that would have been more useful. Whether I would have done something with it, I don't know. But that would be a key thing that would have helped me, because I learned it by accident in my late 20s and had made a bunch of mistakes.
Yeah,
already.
and that's part of this, isn't it? Is that I see so many young people coming out of school, and they set off, and the next minute they've got, this and that and the other thing on tick.
Yeah.
And they've been starting to get student loans and all of that sort of stuff. And when they're then wanting to go on and buy houses or start businesses or anything, they haven't got that.
Yes. I mean, student loans had been in for a few years when I was, not that I finished school, but would have been went to university a couple of years later, and I went to go to Polytech straight, when what would have been my 7th form, and there had been no discussion of student loans because, again, it was a 2 or 3 year old concept that hadn't got down to being taught as part of a standard curriculum, and that was back when it was 6% plus interest. I mean, and so now it's 0%, so it seems easier. People go, well, it's 0. What's the big deal? It's the opportunity cost, and that's a massive thing. It wrapped all around that. If I was going to be critical about it, is do you really have to go to university now? Which is, I guess, if you want to be a doctor, sure. I don't think I want to get a surgeon who's learned off YouTube, but there's a lot of stuff you don't necessarily have to go for. You could spend the money on working and developing skills and learning the academic alongside practical. And that's a whole change up I'm not sure is really percolated, which I've percolated down. And obviously the education sector is probably a little bit nervous about. But you can do Harvard courses for free online. And all this.
That's one of the things that you've touched on in there as well, is the amount of time that it takes to change something. You're talking 3 years in and it wasn't yet being talked about. And if you think about the pace of change then and the pace of change now, it is a totally different ballgame.
Yes. Yep.
And we're still in a situation where the system takes so long to change.
100%.
Yeah, you've got one of your questions here is, so what are the key concepts that you want people to consider financially?
Yes. Now, am I putting up slides, or are we going to do this after?
Slides if you'd like to.
Cool.
Yeah, that would be great.
You need to let me share screens, please.
Yes, will do.
Who I am, disclaimer, of course. So I think that the key things I wanted people to think about, and they actually relate to each other, was, and I've done it broadly because I think in the other questions we get to more deep, cash and debt. And cash is because they rule everything, right? I mean, and debt is really the absence of cash. Cash is about how do you manage what you have and not go beyond that, right? That's something that's really not taught, is that, and it's not taught from government, because government never live. We are not government. We have to live within our means, and that's not taught to us. And also looking at what the impact of debt is on your future. Something I thought of when I was writing this is, debt is your past stealing from your future, right? If you've bought an item today, and I go into more depth later on, you're paying something you bought today, you could be paying for 2, 3, 4, 5 years. Now, it's bad enough if you've bought an item, but if you've borrowed for lifestyle, you could be 5 years down the road still paying for a party that was this weekend. And that's massive in terms of what you're trying to achieve in the future. And cash is simply about the impact of changing how you think about money, your relationship with it, and having a positive aspect to it where you learn to say no to things. So that's probably the biggest part, I guess, is the overview of the 2 key things. I didn't want to go too complex. In fact, most of what I talk about in other questions is about cash and money, but how they relate to things like debt.
And that's one of the things I love about you, Alan, is the way that you're able to simplify everything down so that it becomes just here, 2 key concepts, cash, debt, makes it really simple to follow. So if you're thinking about these 2 things here, then what's the first financial lesson that people should follow?
Live below your means. There we go. Old fable, I think, I can't remember the exact quote of it, but it's like, a man earns, 5 shillings, spends 4 shillings 10, he's rich. He spends 5 shillings and 1, he's broke. And that's, a modern parlance, if you earn $100 and you can live on 99, you're doing okay. If you're living on 101, you're in trouble. The point of living below our means is you have more opportunities. If something comes up, if you are at the maximum of your spending power, you don't get the opportunity to drop your income for a period of time to learn more, to go on that trip that you need to learn, to do more for your future. If you're living below your means, you don't have to have as much willpower, because you just simply don't have to. You're not forcing yourself to stay there, because you just by nature don't live within your means. And this is by design, rather than those few people out there who don't have hobbies and don't have anything to spend money on, don't have kids, that sort of thing, where they just by nature can't spend it as fast as it's coming in. That's not most of us. Most of us have more opportunities than we want to think about to spend every dollar we earn, and more. And for those people, when things do change, they find the habits they thought they had weren't actually there, right? So it's good to live below your means, but you've got to do it by building good habits and having a focus to it, and trying to remove any need for willpower, because life is much harder when you live below your means. From a simple perspective, that I can't, if my core costs that I can't get away from are 60, 70% of my income, I can't take a few weeks leave without pay. I can't go on a trip. I can't take a lower paying job, because now it's very tight. But if I can get those non-discretionary costs down to 30% of my income, regardless of what my income is. I've met plenty of broke people on $300,000 a year, and people on 50 grand a year with plenty of money in the bank. It's a mindset thing. If you're living at 30% of your expenses, you've got the ability to make choices. So this is the first step, and that's very hard. Say coming out of school, if you go straight to a job and you've been living on your parents' pocket money or whatever, you finally get to do something. It's very hard coming out of your university where you lived on the smell of an oily rag. And now you suddenly have money, and I always say, try and live a level below you, live below your income, below your status. Status is different. That's one of the next things I talk about. So there we go.
Absolutely. That's really, really helpful. And I love that. One of the ways that you've framed that is that you're stealing from your future. And this is part of that as well, isn't it?
Yes.
So what's a way to make it easier to manage spending?
Yep. So the first step is definitely doing a budget. The problem with the budgets is I've met many a person with a budget that did a budget, and I say, if it was a physical handwritten one, it doesn't do you any good sitting on a shelf. It doesn't look really good as a saved spreadsheet you've never looked at. What I like is something and it's not much use. I don't like systems where you track your spending and each month you see how badly you did, because it's not real time. Right? And you need to know at a glance what you're doing. So I break it down to bank accounts. So you do a budget, definitely. Because you need to be able to figure out your expenses and make sure that the planned expenses you have are giving you at least $1 in surplus. Obviously, you want to be living well below that, but that's a start. We've got to get from negative to zero first. Then it's about how we structure our bank accounts. And to start with, I want 3 key ones. Core expenses, that's regular expenses that are fixed in amount, generally paid, automatic payment, direct debit. That's rent, power, rates, insurance, that sort of thing. By putting them in an account that has no FBOS card on it, that is all just there to pay those bills, you can now suddenly ignore them. So I've removed a whole bunch of mental effort from my life because I never think about my mortgage payment. It just happens. The money goes in on payday, and there's a buffer in there to cover random unexpectedness, if it's like bad timing or whichever, but it just happens. Then I have my household expenses account. This is for regular expenses that are variable in amount and have to be FPOS or cash. Groceries, petrol, public transport. You might have a Zumba class you pay for every time or something like that. That has an FPOS card. We don't merge the two because I don't want to spend the power bill at the supermarket. And we don't, and because I want to make sure that the money I've got for my groceries is clear. So when I'm at the supermarket, if I've allocated $200 a week for groceries and petrol, and my grocery bill sitting at $180, my tank's got the yellow light on it, and I haven't filled up yet, well, I'm possibly walking to work if I don't, if I need more than $20 to fill the car up. At a glance, I can tell. And then my next account is my personal expenses, pocket money, the money you're allowed to waste. And I used waste importantly because this is core and household is all very responsible spending. There's some fun in there, you have to eat, but it's not going out having fun. And pocket money is whatever that means to you. Hobbies, coffees with friends, go to the movies, random stuff that you do. And we want that there because I don't want to spend it on the power bill. I don't want to spend the power bill at the pub, and I don't want to have it in the groceries where I'm not sure what's going on. So what this does is we're treating almost every expense you have whether you fortnightly or monthly, as the same regularity. And every pay, we divvy the money out. Now, there are some expenses that don't fit neatly into this. And this is the second part of it. Savings accounts. I call some savings, all savings accounts are pre-spending, but this is definitely pre-spending. We're not saving for the sake of it. These are the irregular things that either we hope don't happen. We want to have an amount for each year in case they do. So medical costs, or targets we want to make sure we spend throughout a year. So presents, clothing, that sort of thing. And things like, the car, WAF and rego. And if I know, for example, that I need $1,000 a year for presents, then that's $38.46, I think it is, a fortnight has to go into that account. So throughout the year, if it's time to get a present for someone, obviously it's December, so it's going to spend the year doing nothing and then spike in spending in December, I can look at my app and go, here's how much I can spend. So when I go get my haircut, on this Friday, when he gives me the bill at the end, I go, hang on a second, I jump on my app, I transfer the money from my haircuts account to my spending account and pay for it. I need to have to think about if I have enough money for that. So the combination of all these means that every fortnight is the same. A lot of people live at their lifestyle up here, and then one of the expenses comes along and they go, oh, it drops down. And they feel bad because now they're living at this lifestyle for the rest of the pay cycle. But they're living a false economy up here. They never had this much money. They just put all the registration money, presents money, travel money, medical money in their pocket and then spent it. But actually, if you lived here and never lived here, you'd never notice the drop because you just live here consistently. And the money for those other events is building up behind you when it's needed. Now, some situations will blow it out, but you're used to it and you have an emergency fund for it. So we're living within our means. We're not having these peaks and troughs. People who every fortnight try and say, right, this month, this pay cycle, it's power, I'll pay that. On next pay cycle, it's rates, I'll pay that. I guarantee you that one pay cycle, it'll be 2 of them, and then you're done. This way, and you don't want to be in a situation where a $300 bill blows out your budget. That's in this system, it can't, because every fortnight, the $12 for the car, whatever the number happens to be in your budget, disappears into the account waiting for you. It looks messy on the surface. But the only place I'm thinking is here, personal expenses, and I'm only thinking about, I never think about core expenses. I'm only thinking about household expenses when I'm at the grocery store or at the petrol station. And then I only think about these ones when it comes up. I'm getting my haircut Friday. I don't think about my haircut account other than that, because it just does its thing. I've developed it that way. If I find that I'm spending too much money and it's going down quicker than I thought, then I need to check my budget. Maybe I've got my numbers wrong. So that's the first thing. And then you get that, and then you live it like that every fortnight for the rest of your life, really. And even when you don't need to, right? Even when you've got plenty of money, you still put money aside. You've just got less worries about if you get a bit tweak it, but it stops you overspending. So this is what I call the first lesson of finance, right? Is do a budget. And doing a budget, people think is the first lesson. It's do a budget and then do this to make this is the practical from the theory. So there we go.
And this just makes it easy. And as you're describing it, it is taking that weight off your mind, because it's removing so many things that we have to think about. I was talking to somebody the other day who was describing what their mother did, which was when they got the pay packet at home, was they had 9 different jars, and they would divvy the jars up.
There's nothing new under the sun. This is the jar system, the envelope system. People have, plenty of people have developed it. It's just a version I've taken the good bits from lots of other people, and I use it myself. I've tweaked it over the years to work with people. Some people ask me, hey, I don't see credit cards on your system, and I go, yep. Credit cards don't fit on the system, because if 3 examples. If I'm at the supermarket and I've got a budget of $200 for the week of groceries, the 3 ways, what are the 3 options for making sure that I stay with that limit? Cash, an FPOS account that's got $200 available in it, or a credit card with a $1,000 limit that I'm hoping to only spend $200 on. Well, the credit card is not going to keep me the limit, because I could just spend and I'll deal with it at the end of the month. The bank lets me go into overdraft on my FPOS card. But I know, at least if I look at my app, that's the limit. I can stop myself better than I can with a credit card. And cash, of course, is you can't overspend on cash. I'm not advocating cash all the time, because it is difficult to do these days. But I don't use credit cards, because they will. The credit card companies are not stupid. They will find a way to chip away at you and make you overspend, even if you don't realize it. Even they are patient companies.
They're very, very patient. And that's one of the advantages now with the debit cards as opposed to the credit cards.
100%.
We'll use them online, but we have to have that money there. So
yes,
that's a really, really good thing. Okay, so this is, as people are starting off and they're budgeting and they're putting into place these processes to reduce the stress and help us to manage money, what's a trap that people fall into with their finances as their income grows?
Yep. Lifestyle. It's called lifestyle. I think so. Lifestyle creep, keeping up with the Joneses, whoever they happen to be. I've heard too many statements. Well, I had to buy this car because, as our insert job here, I should live at a certain level. No one has those expectations. In fact, it's you who has them. If it's funny when I've been to a few in the past, you'd go to an auction or something when I go with clients, and you pull up and there'd be 7 or 8 BMWs from all the real estate agents who were showing up. And my first thought is, how many of them are on tick? Because I doing my job, I've seen a lot of car loans in the years. And apparently I heard on the last week, 90% of vehicles in New Zealand are on finance. So it's not a hard guess to assume that is the case. And of the remaining 10%, I guarantee a bunch of them are put on the mortgage. So the key here is that ideally you'll get pay rises. You'll go up in income and levels. If you're old enough to be in the workforce for 10 years, you'll look back and you'll be earning a significant portion. Ideally, if you've got time out for kids, etc. Sure, but ideally, if you stay consistently in work, you'll be earning a lot more than you're earning 10 years. My first job in '96 was on $14,000 a year. Didn't take a lot by 2006 to be earning more than that, right? And it keeps going up with inflation as well, but we're earning more. So every time you get a pay rise, well, most people live at 100. New Zealand, I think it's 110% of our income is what we live at. So we're already living beyond our means. Your lifestyle will fill up every gap as possible if you don't stop it. So whatever your income is, your lifestyle will fill that. So I have people telling me, I've been a graduate for 6 months. I was earning $7,000 a year after, my parents paid my board or whatever. Now I'm earning 45 or 50. How can I have less money when I'm earning 7 times the amount? Because your lifestyle filled the gap. You didn't make a conscious decision to do it. So if you run a car, you buy a car till it runs down. You own it till it runs down. You live at a level below. So if you're a graduate, live like a student. If you're a student, live like you're at home. If you're a middle manager, live like a line worker. If you're a senior manager, live like a junior manager, and so on and so on and so forth, right? And obviously it's not a hard and fast level, but in fact, ideally keep the student mentality as long as you can, but I appreciate that's difficult to do. But for a couple of reasons. One, I'm at a level where I could, I guess, if I wanted to go to really expensive restaurants all the time, putting aside the time I had with children, the ability to do that. But that once a year or for anniversary sort of thing, where you go to the restaurant where you spend a few $100s on a meal for 2, that feels quite special. But if it becomes part of your routine, then that goes away. And then what happens is you have to go even more expensive to fill that gap. It becomes a dopamine thing. But if you stay living at the level and you enjoy what you've got because you've got a mission for the future, then when you do those special things, they'll actually still feel quite special. If you and I've seen this with people who, my curse is knowledge. So I know often the financial situation of people, and I just have to keep it to myself because I know that person shouldn't be spending that money, but it's not my place to tell them at 10 o'clock in a pub on Friday night. So if you can live below your level and you don't fall for lifestyle creep, you don't buy a bigger house on the hill because you're supposed to, you don't buy a bigger car when your car is perfectly valid. When it's time to upgrade, because you've got kids and you need something that moves around better, don't spend $30,000 because you feel you should. Spend 10 or 12 or 15 in cash, because ideally in cash, because it's just as good. And keep that mentality as long as you can, and the difference in your wealth in the long term will make a massive, massive difference. And I've seen that with people.
I love that link that you put in there about keeping your mission in mind.
Yes.
And we've had quite a few people through the course of this conference talking about their purpose, talking about their mission, and it does provide that motivation, doesn't it? Yeah. I've got a reason why I'm living like this.
That's
and
right.
It means that we can have that.
And it's difficult because if I go back to when I started, when you're 25, retirement's another planet. The mission is so far ahead, but it's also not. So you have to break it down into those. I haven't got into it in this because I'm talking primarily the money to get started. But having a clear mission for your future, it might be as simple as, graduate, get the job, get a car I afford in cash, go on a trip on cash, save for my first home, save for the wedding, save for my family. Keep doing it while also filling in the long-term mission. This is still critical to that. And this will make sure that you get to stick to that without having to borrow and deal with it later on. Have to make sacrifices that you shouldn't have to make.
Absolutely. And for those people that are wanting to start businesses and so on, this is absolutely critical as well, because not only then you would also have the capital, if you like, to be able to start that business
100%.
and to bring that financial understanding into the way that you're running your business as well.
Yes, absolutely. Yep, 100%.
Okay, so the next question then is, we do need some of these larger items and these goals. So how do we best pay for those? And you've touched on that a little bit, I think.
Yeah. So as I was going through my notes of this, I realized that a lot of stuff I'm doing, I'm linking forward and backward, but that's actually the reality of this is that pay cash, right? I'm not talking about necessarily, taking cash to go buy a car. I mean, I'm talking about paying with money you have, not someone else's money you're going to borrow, pay back later on. Though, the first maxim I was taught when I was learning financial planning was, you've got three ways to save money. One is an FBOS card with an account with an FBOS card attached. One's an account you've got to go in and physically get the money out of, and one's a tin can with a hole in the top and the lid welded shut with zero. And you've got small. Not these days, it's almost all no interest, but there's more interest on the other two. But the tin can is 0%, which has more money. Tin can, you can't get it back, right? Until you need to open the tin, it's more effort. So what I'm talking about here is paying for things in cash by saving the money for them first. Sometimes this is unavoidable. I'm not talking about paying for your house in cash. That would be nice. Certainly not in New Zealand. But if you're able to pay for things like a car, pay for travel, pay for consumer goods in cash because you've built up the money and you're prepared to say no for a little while, you're going to be in a much better position. It feels better. And an example of this is this. In my first marriage, because it's not that the marriage is relevant to this, but in my first marriage, we'd go to trips to Australia, and maybe we'd spend $3,000 between the two of us, and we'd pay a little bit of cash, but mostly it was on credit card, and you'd come, and you'd spend more money than you should have because I've done this much damage anyway. What the credit card bill's already going to be a problem. I'll wait. What the hell? Ask forgiveness and permission. You'd get back, and the bill will be waiting for you, and you have to pay it back before you could do anything else. On my second marriage, before we got married, but in my second major relationship, we went on a trip to India. We spent $10,000 each, but we saved for it for a year or so beforehand and paid for it in cash. We came back with money left over because there was no need. I didn't want to buy another rug, and I didn't have to because I had the money for something else. And when I got back, there was no bill waiting for me. In fact, we had a little bit of money left over, and what we got to do was instantly start saving for the wedding because we got engaged over there. And it was in 10 months' time. We renamed the account to wedding and just kept saving. Well, if that had been a trip on credit card, we would have kept going. It felt so much better. It was a 6 times more expensive trip, but it was in cash. And the thing with cash is you're looking forwards, not backwards, right? I'm not sure I'm not sure which is worse yet. No one's told me whether whether paying for it, if it's a wedding that for a marriage that didn't last, or for a funeral on debt is worse. No, I think it's different for each person. But that people have borrowed money for funerals or borrowed money for weddings, and then the marriage hasn't outlasted the loan, right? If you pay for it in cash and it doesn't last, oh well, just carry on, right? I mean, obviously there's other things to it, but the cash makes a big difference, and it keeps you available for opportunities. If I'm saving for a goal I want $20,000 for, and I've got to 15, and then another opportunity comes up that I want more, I can redirect my savings. Or I get to that goal and I don't want to do it anymore. I've got 20 grand. I can use it for the next opportunity. So yeah, so that's the key thing.
Same thing happens with cars, doesn't it? The number of people that buy a car and they buy it on finance, and then they crash the car or whatever, and the insurance money pays up, but it doesn't even cover the cost of what you borrowed for the car.
I have lost track of the number of people that we've not been able to get mortgages for because of the car loan. They've said, well, I didn't think I'd get a mortgage, so I went and bought a car instead. And they didn't go buy a car. They made themselves feel better by buying a ridiculous car they shouldn't afford. You know, and now there's no chance. If it's a $3,000 or $4,000 car loan, fine. But when it's $20,000, $30,000, $55,000 for a car loan, that's your ability to buy a house gone for years, because you can't just sell it. The car is worth less than what you owe. There's no getting the money back. So keeping the mentality of paying cash. Yes, there's a trade-off where, you know, people say, but I have to do more repairs on the car, for example. And cars are a big thing. It's very commonly paid, as in 90% of cars are financed. If I buy a cheaper car in cash, there is a point potentially where if I spent more on a better car, it would run down less, and I wouldn't have to do as many repairs. But once I've paid for that car, if I buy a $5,000 car in cash, which I did early on, I mean, my $13,000 car cost as much as every other car I'd ever owned combined, and I owned 6, right? But I paid for it in cash. That $5,000 car might have cost more to run, but I didn't have any debt, so I just kept putting it aside. So there is a leveling point, but cash gives you options. So I'm not saying buy a $2,000 car instead of a $5,000 car. I'm saying buy a $5,000 car instead of a $25,000 car, or a $10,000 car versus a $50,000 car. You know, like somewhere where you can pay for it in cash and afford it, because it's got better options in the future. And right now, if my car dies, okay, I go buy a new one. It's annoying, and I'd rather have the money, but it's a step back and not a borrowing. Like, it's a reduction of my assets, not an increase in my debt.
That's right. And the other side of that as well is that you've got your depreciation, which if you've got the more expensive car, it's coming down hugely. You've got your interest, you've got all of those sorts of things as well.
Be very aware of the interest cost of stuff. I had someone tell me that who had paid off the car with the plan we did, and then because the car was costing $1,000 a year to do repairs on, they went and bought a new car. Well, they borrowed $55,000 for this car at 12%. Now you don't have to be a math genius to know that 12% on $55,000 is more than $1,000 a year. So it was an excuse to get a better car, and then you know, for $5,000 of extra interest a year at least. So, and potentially repairs anyway, right? Cars are fickle like that. So, so one thing I'd say is be very careful of I mean, talk about lifestyle. Car lifestyle creep is crazy. That goes back to one of the earlier slides.
Yeah, absolutely. Okay, so now we've got people living within their means. We've got people starting to save before those big goals, before they spend them. We've got people reducing the amount that they're spending on those sorts of things. Maybe it's time to start investing. What's a good way of starting investing?
So I want to keep this reasonably straightforward. Focusing long term, and the next slide I've got, which is part of this shows you some of the maths. So we'll do the concept first. Time in the market is more important than timing. I am not interested in what Bitcoin did yesterday, or what this company is doing, or what XYZ politician said that's changed the market. That stuff happens. I have a graph in my office from one of the providers we deal with, and there is an issue every so many years that wobbles the market. So time, being in the market for as long as you can. Start long-term saving as soon as you can. If you're in New Zealand, from your very first part-time job as a student, if you're at school, be in KiwiSaver, putting the maximum you can afford in, and once you're over 18, putting the maximum you can get in to get your free money from the government. And if you're in other countries, whatever your equivalent is. Start small, it all builds up. It's not about big numbers, it's about steady accumulation of small numbers. And I say investing, I'm not talking, this is not necessarily just for retirement, this is whatever, it's savings, etc. If you've got goals, this all fits to this. I'm not worried about a specific product. I don't care about passive versus active. the specific fees, yes, they're important, but people focus on the product, not the thing they're trying to achieve. What you need to know is what you're trying to do and put aside the money accordingly. So but you don't do it, and it's not here, but you don't do it by accident. So you don't figure out what's left every pay and put the money aside. You target, I am putting $100 a week aside, therefore this is happening. And then you figure out your lifestyle after that. So you turn around. This is paying yourself first. Paying yourself first is not paying yourself for fun. It's paying yourself for your growth, and then your bills, then your fun. So that's why I say don't get caught up in the product specifics. Focus on what you're trying to achieve. Yes, if you've got a 2-year goal, you would invest differently than if you've got a 40-year goal, 100%. That's not what I'm talking about. I'm talking about don't worry about whether you should be with this company's fund or that company's fund or this term deposit. Just put aside money. That's more important. Get into the habits. To show you the maths of long term, these are two specific graphs. On this side, you've got a 45 years. This is a 20-year-old, really. So a 20-year-old starting from day one at $100 a fortnight investing for retirement or a long-term goal. If it goes up by 3% a year every year, in 40, I've snipped it because it's a long graph. In 45 years, that $100, you can see it goes up $3 at the end of the first year and so on and so forth. At the end of the 45 years, you're putting away $367 a fortnight, and you've made 435 grand at a 3% low year. That's a very low return. I don't like to overestimate these things. If you wait till you're 30 and do the exact same thing, you've got $252,000. That's a difference of $180,000. If you've put in $83,000 more on the first land, you've made $100,000 more in free money, interest return. And that's at 3%. Imagine this at 4, 5, 6, 7 if you're doing growth investments. That's why I say time. Right? Now, at age 65, this person's not getting the money out. They're going to keep investing and if they're going to dip into it. But they've got $180,000 more options than this person. So that's why I say time in the market. That's a low return, but you've made a lot more money than you would have by not doing it. So this is what I'm saying is the get started. Doesn't matter when, doesn't matter how, but the sooner the better. The best time was yesterday. The second best time is today. Right, putting some money aside, and as we get to the future things, this is where the impact of debt will come into it, which I'll show. So this is why I say, if you're just start and just be in the market, right? Don't look at your KiwiSaver every day or equivalent. Look at it, look at it out of interest and go, that's nice. Oh, it's gone down. That's nice, because you know that eventually it's going to be this sort of number here. So there we go. That's my thing on investing. I don't like to overcomplicate investing. It's not. There's lots of very clever people out there with very clever products and things that make it complicated. I don't think we need that.
Mm-hmm. Yeah, absolutely. And there's been a lot of people that have been chopping and changing this year, but that's a whole other story. So if we're you're talking about time in the market, get in there, just stay, right. What's the biggest impact on people's futures then?
Debt. Debt steals your future, right? This is an example here of a debt. So this is a $20,000 car loan at 12%. It's $200 a fortnight, right? So double what that previous growth example showed. And it's going to cost you another $6,600. So if you bought a car, I don't know, you might have paid $22,000 for it and put in $2,000. It might be after 5 years, it's worth $7,000 or $8,000. It's cost you a lot of money to do that. If you could invest that differently, instead, that'd be a huge difference. And this is small beans to what I'm seeing, right? During those 5 years' time, that $5,000 a year you're not putting into anything else now can't be used to chip into a business, can't go on a trip. You might not, you can't sell the car for any money really. How do you get ahead in the next opportunity? And this goes back to this is student loans as well, really, even though there's 0% in New Zealand, right? It's the cost. I could do another graph showing you the cost to your lifestyle and student loan, right? So be very clear about what you're borrowing. If you can stay at home, live off mum and dad. Don't borrow the living costs, or beer money, which it often ends up being, because you have to pay it back one day. And I paid $45,000 in interest on my student loan, so I know a little bit about student loans, right? Opportunity cost. So I could do a whole hours on debt, but I think the main thing is, look, some debt is necessary, some debt is unavoidable, but whatever we can do to minimize it and not borrow when we don't need to. And that's education, cars, lifestyle. That's a huge huge impact on your future, right? Like I said, I meet people who, 3 years ago bought a car on 5-year loan, 3 years ago refinanced the car into another loan. They haven't paid the first car off, and they've got a second car, and now they owe $28,000 on a car they paid $20,000 for, and they're going to pay $40,000, $50,000 on these debts. And they, I got 11.5%. Doesn't matter. Living in cash, all the things I said earlier, and avoiding debt where possible makes the biggest difference to your future, right? The people I meet at 40 or 50 who didn't get to this level, whose mortgage is is low or nearly gone, regardless of where they started, right? The difference of their retirement is massive. Every year you could be mortgage free, putting money aside. Even just if you just do a job, you get a job and you buy a house, you stay there for the rest of your life, and you never aspire to massive, CEO and all that. You don't have to. This is about your situation. There's nothing wrong. I say there's nothing wrong with aspiring to work at the biscuit factory and make your money there and spend time with your kids and grow a family and have a house. Because as long as you're the best biscuit factory worker you can be, and you live within the means of that person, by not taking debt, buying the cars that fit your level in cash, being mortgage free as soon as possible, you could be the wealthiest retired biscuit factory worker ever, because you could be mortgage free by 50. That's 15 years of putting aside money into retirement. And I showed the other graphs before, makes a massive difference. You could be $200,000 or $300,000 better off than someone else simply because of the cars you didn't buy and how you position your mindset. So I don't want people thinking that's about, well, I'm never going to be that aspirational. I don't want to work. I don't want to be a CEO. I don't want to be an entrepreneur. I don't want to aspire to this thing. I want to have a family, have a basic life, and focus on my life and do my 9 to 5. Fine, but shape your finances around that, right? Don't have that limit. Don't have that career and then try and live like the person working 60 hours a week as a high-powered lawyer, right? They don't match. And the high-powered lawyer has to understand they've got to give up some lifestyle stuff, right? But they shouldn't be trying to live like the guy who owns Weta or the film actor. Like, you've got to live with it. Whatever your level is, you've got to live there. And it's not a status thing or a class thing or a better or worse thing. It's about the decisions you make in life. And I think that's something is that we'd all like a better car. Sure. There are cars I aspire to that I'll never buy because practically they take too much away from my wealth. And at whatever level you're at in terms of wealth and income, it doesn't matter. That's the key thing. And debt humbles all of us, because someone looking at us earning 200 grand a year goes, 20 grand, who cares? And they're right. But that person is not borrowing 20 grand for a car. They're borrowing 80, right? Or 100 or more. And they've got $1 million mortgage or more, right?
And you're talking about cars here, but I look at the young people, and a lot of them aren't necessarily looking at cars. It's when people are getting a little bit older that they're thinking about cars. But what they are looking at is the technology, is the phones and, computers and those sorts of things, or the subscriptions to things. And
everything bleeds. I mean, the reason I use cars is that a lot of the young people I do talk to, a lot of them, if they're living in a city and something like that, or they've got public transport or they're slightly more eco-aware, they're maybe not driving. But for a lot of people in the early 20s, I'll meet 22-year-olds with cars that cost double what I paid for mine. And there's just no logic to it. And that's not even at the high end. I paid $13,000 for my car 8 years ago, and it's still going fine. I will run it till it dies, right? And it literally dies on me, and then I'll go buy one in cash. So it's not that, but you're right. It's that. In fact, those are the easy examples. The hardest one is the every 2 years a new iPhone, right? If you've got, I don't know, iPhone as well, but if you've got the Galaxy 2, 3, 4, 5, 6, 7, 8, 9, 10, it's a problem, right? You want to skip at least a couple of models, let it run out. And if you've borrowed for them, because the telcos will let you pay no interest on them, they'll give you $1,000 phone, and it's only X amount on your phone bill. Those are harder to track because that's a bleed, right? A $16 Netflix thing here and a $12 Amazon thing there, and it adds up. If you add up if you're a coffee drinker, how many coffees a week are you having? So cars are an easy example, but the budgeting for things like the slow bleed on things, that's more difficult. And yes, I think for some younger people, it's the latest phone, the latest clothes, the latest this, the latest that, that's very much lifestyle, but it's harder to keep an eye on because it looks small.
Yeah, absolutely. And it's only $5 a week on this thing, and it's only $7 a week on that thing, and $3 a week on that thing. But by the time you've got 7 or 8 of those things, and you're on minimum wage or on a benefit or anything like that, it's too much, isn't it?
in many cases, yeah, absolutely. In many cases, you know, we could generally find a couple of $1,000s a year of money that if someone was serious about stuff, they could free up. You know, they don't often want to, you know, they don't want to give up Netflix. They don't want to give up this, but they want to be debt free and buy a house. Well, you know, and I work on the theory that it's not my role to say that you shouldn't have Netflix. I don't care if Netflix or not, you know, but back when it was a bigger thing, you know, my first 5 years of counseling work, if I'd written a book, it would have been called All Broke People Have Sky, because everyone I spoke to who said they were stuck with their budget and couldn't figure out how to get ahead hadn't cancelled Sky because that was a decision they didn't want to make. Now it's more insidious because it's you know, by the time you've gone through Amazon Prime and Netflix and Hulu Plus and HBO Go and Disney Plus, you know, you could end up spending more than you would have on Sky for all the stuff like that. But we could generally find some discretionary spending that people, they don't think is discretionary, but if the goal is big enough, then you will cut the things that aren't important. If you won't cut Netflix, then you probably don't want to buy a house. For some people, that's the trade-off. And it's being aware of that. And that's okay, as long as you've made the decision that I'd rather have this Netflix than buy a house. Well, it seems like a long chain, but it's Netflix and it's this and it's this and it's this that leads up to the $5,000 of extra savings in the next 5 years you haven't got towards a house deposit. You know,
and that comes back down to what we were talking about before, which is around the mission, around the purpose.
Yes.
What is it that you're wanting, and how much do you want that?
Yes, 100%.
You're prepared to make
Yep.
some of these big decisions. So
yes,
yeah,
100%. Yeah.
Okay. Well, thank you so much, Alan, for
No problem.
sharing your knowledge around finances and for sharing the journey that you have helped lots and lots and lots of people on. With the clients that you've been working with people from a really wide range
Yes.
of industries and ages and all of that sort of stuff. This is so important for
Yes.
people's futures, and I really thank you for sharing that for our people today.
Happy to. Thank you very much for your time and opportunity.
Thank you very much.